welcome to, just to make sure you're in the right place, although I'm sure you are, the core principles of financial management. All right. My name is Rufus Washington. I'm a HUD employee. I'm CPD director in the Atlanta regional office. Working with me today is a longtime friend and colleague of mine in the back of the room, Wayne Itoga. He's the session coordinator, and Wayne's out of the Los Angeles office that I formerly was with. And he'll help us with the logistical stuff in the back, particularly as we notice the room filling up, to make sure if there are vacant seats in your area that those that come in will be directed toward them. In addition, when we get to the question and answer portion of the presentation, he will bring a microphone around to you so that you can be heard and you don't have to climb over your friends and colleagues to get to the microphone that's stationed there in the middle of the room. All right. We're going to ask, just as a general housekeeping thing, if you would hold your questions until the end of the presentations. That would be helpful. There's a lot of information that we want to share with you, and so just doing that will help ensure that you get the information that you came here to get. So once again, welcome. Let me tell you a little bit about this session, all right, and why we're doing this. A key component of excellent HOPWA program management is good financial management and practices, and it's not just something for your CFO, Chief Financial Officer, or CEO, Chief Executive Officer, to worry about. In fact, it involves all staff at a HOPWA agency in terms of meeting the requirements and the principles of good financial management. The goals of this presentation are to communicate clear guidelines for sound financial management, increase understanding about direct and indirect costs, define common terms, and provoke critical thinking about the financial aspect of program management. Topics include basic cost principles, the idea of a paper trail that extends down to client files. That's kind of like you, case managers. Grant-based accounting, financial and client file documentation, and documenting personnel time. In order to cover that kind of information, the kind of detail that's going to be beneficial to you, it'd be helpful to have two people who know what they're talking about, right? Well, we've been able to achieve that, and we've got two excellent presenters, and I want to present them to you. I will present them to you in the order in which they will be speaking today. First is Dr. Jonathan Sherwood. Dr. Sherwood, and I'm sure he doesn't mind John. Is that okay? Okay. Oversees the Cloudburst Group's management of data collection, validation, and analysis for HUD, for our Office of Community Planning and Development, which the HOPWA program is housed in. And not only HOPWA, but Continuum of Care and the Emergency Solutions Grant Program. He works as part of our Housing and Community Development practice area to provide direct support to communities across the country with planning and implementing special needs and homeless housing programs with a particular focus on compliance, monitoring, and grant management. Dr. Sherwood directed all housing programs for a Boston, Massachusetts sheltering organization for 3 years, including 2 family shelters, transitional, and permanent housing. For over a decade prior to that, he provided technical assistance across New England for HUD's AIDS housing program grantees and authored a compliance guide for the HOPWA program. He has worked for 2 decades in the homelessness and AIDS housing field. Next, I'd like to introduce to you a familiar face and voice that you've seen throughout this conference so far, but I'll introduce him again, and that's Rusty Bennett, otherwise known by his mother as Russell Bennett. All right. And he serves as the Chief Executive Officer of Collaborative Solutions with an administrative office in Birmingham, Roll Tide, providing organizational management and program implementation services. He currently serves as Executive Director of the National AIDS Housing Coalition and Executive Director of the Professional Association of Social Workers in HIV and AIDS. With nearly 20 years of experience working with issues related to homelessness, housing, and health for vulnerable populations, he has experience in working with nonprofit organizations and the federal government. In his role with the federal government, first as a presidential management intern and as a career employee, he has worked at HUD, Office of Housing and HIV/AIDS, which administers the HOPWA program with over $330 million in funding. Rusty received his doctorate from the University of Alabama School of Social Work in 2009. So without any further ado, I'm going to let these gentlemen begin their presentation on the core principles of financial management. Thank you.
So I'm Jonathan Sherwood. Thank you all for attending this presentation this morning. Hopefully it will be interesting and informative for you. As has already been mentioned, there's a lot of detail and content that we'll be covering, all of it pretty inadequately because it is can be some pretty technical material in here. But hopefully there'll be some time for questions and to be able to address some of what might come up. But I guarantee there'll be a lot of things that will bear more clarification for you after the training that we will not get to. But you can ask the questions that you might have. Of course, we have the microphone here, but in the app, if you haven't done that already, those will be coming up here to the moderator. So feel free to submit those all the way during the presentation this morning. So to start off, how many folks are grantees? And how many project sponsors? Okay, so a real mix. This is applicable to everybody here, the content, irregardless of your role as either a grantee or project sponsor. And as Rufus said, it's also applicable whether you are have a management role in your organization or whether you're providing direct services. I think one of the key concepts that has already been mentioned and we'll be talking about is this idea of a paper trail, and that paper trail that backs up all of your financial management and your expenses, and ultimately what HUD and the federal government are paying for. That involves everybody in the chain of command at an organization. So even if you're not in management and have that kind of responsibility, I think that this will be applicable. A lot of the content is at that kind of higher level for organizations, but I think it'll apply to everybody. So this is a standard slide for all the presentations. It's the theme of the conference, Housing's Role in Ending the HIV Epidemic. And as much as possible, we've wanted to connect the content of each of the presentations to this theme. I would be interested in asking you all the question: what's the connection with our material today with that theme? Some of the presentations and sessions might be more obviously connected to the concept of ending the epidemic, but I'd be interested in getting a shouted out response or being good stewards of the money. And I think that says that there's a number of management track presentations here at the conference, and I think that's the connection. It's to ensure that the resources that the federal government's putting in and the American people are putting into your communities for these purposes are being well spent and kind of hitting the mark, being done efficiently and effectively. So that was it. The objectives for today have already been communicated, so I'll just have that up for your reference. Also a reminder, as with all the presentations, it's available. This slide deck is available as a PowerPoint PDF in the app through the session, so you can have that for follow-up as well as following along this morning. So we'll be talking about these major themes throughout, about the concept of a paper trail, the different elements, kind of milestones in the grant agreement relationship, and some of key elements in administrative and service delivery activities as expressed in this slide. So thinking if you're coming to this training, if you're coming to the policies and procedures training, if you come to the monitoring training as part of that management track, this slide, I think, tries to encapsulate how all of those different pieces fit together. So your grant agreement, whether you're on the grantee side or the project sponsor side, there's a whole management cycle to the use of the funds, starting with the planning of those funds, the procurement of subrecipients or project sponsors, contracts that have been talked about in some of the other sessions, monitoring in the policies and procedures session, where the contracts will express and document requirements and expectations, including financial requirements, and then the ongoing operations, grantee monitoring and project sponsor self-monitoring of their operations, all in a cycle and all centered around the different HOPWA and federal regulations that apply, what is specified in your particular grants, and what kind of written standards the grantee and the project sponsor you might have in place. So that's the big picture that is kind of threaded throughout all the presentations that we're looking at. So today we're going to be focusing, it says today's focus is limited. I wish it doesn't, we'll be covering a lot of ground. I know I've already said that. So it is limited. We're not going to be talking too much about, at all about activities, HOPWA activities themselves. Really will be about financial management, but in that sense, we're covering an awful lot of ground. This is some of what we'll be talking about throughout. There are a number of resources that are already available on the HUD Exchange. The first one, the Grant and Financial Management module, that is a CPD, or the Community Planning Development wide. That's a division at HUD that includes the HOPWA program. There's some online 101 and 201 financial management trainings starting at that address there. I highly recommend those. They're not HOPWA specific, but neither are the financial regulations that govern the management of the HOPWA program. They're applicable beyond the HOPWA program. And so those online trainings that are on demand, you can view them at any time and at your own pace. Highly recommend them. I think they're great products with that Financial Management 101 and 201. There's also a HOPWA specific model. It's an older training, but it is currently, I believe it's still required training for grantees and project sponsors, the HOPWA specific financial management online course. There is also, related to that latter training, the HOPWA specific training, there is a guidebook that covers a lot of detailed ground that you can download as a PDF. Finally, there is the HOPWA Grantee Oversight Resource Guide available at in the HOPWA section of the HUDexchange.info website, and there's online training connected with that. So there's a lot of resources that will go into more detail than we can go into today about specific concepts, and can provide you with a lot of written and visual information about it. So I wanted to start with this, that I'm a service provider, not an accountant, but the fact is that if you're managing federal funds, there's a lot of responsibility that comes with that, and a lot of, I think it's fair to say, a lot of potential liability that comes with that in terms of making sure you're doing things right. So it's the responsibility for having a well-run program that is compliant and that has sound financial management really, again, flows through an organization. It's not just the issue for the CFO. It goes down to the case managers in terms of ensuring that client files are well put together, have lots of clear documentation that backs up all of those dollars spent. It is the program folks on the direct side that will be creating a lot of the documentation that backs up all of the charges that your back office, your accounting office, will be booking and eventually be charging HUD for. So it's a real continuum. Everyone has a role in the system. So even if you don't see yourself as an accountant, and I imagine that probably most of you here are not necessarily trained in that role. Everyone, these are important concepts for everyone. Why is it important? Well, the federal government has some very specific expectation and regulations that guide financial management. Who has ever heard of 2 CFR Part 200? All right, that's pretty good. Who has ever heard of, familiar just generally with OMB circulars? Okay. So the 2 CFR 200 is a few years old now. I think it'll be 3 years old in December since it was published. It was a part of the Code of Federal Regulations, that's the CFR part, that codifies for across the federal government the use of different financial management and cost principles for the use of federal funds. It replaced some older guidance, what you might be familiar with from Part 84 and Part 85, and some of the OMB circulars like A122 and 133 and 110. All of those are rolled up and superseded by this. So if you have old money that you're spending that was pre-publication of this as a grantee, then that would fall under the old guidance. All of the new money that might have any awards issued after this guidance was released is governed by this. So it did, I think, a service to everybody by consolidating a lot of very spread out information into one section of the federal regulations. And it tells what you need to do to document compliance, what standards you need to be meeting. There's requirements that you are able to generate grant level financial and performance reports, so at a detailed level, and we'll talk more about it. And there's this whole concept of being able to trace your funds to the individual funding source in grant years at the program level. So it really puts a lot of requirement on the grantee and the project sponsors to be able to know for every dollar, what activity it's attached to, what eligible activity that dollar is attached to, that's tracked, it's dated, and that at the grant level for the grantee, they're going to have to report to HUD, this was FY17 money, this was FY16 money, this is FY18 money, and be able to slice and dice it, all that financial data, and all your related performance data, the outputs, the outcomes that you do in your APR and CAPERS, all of that kind of needs to be relatable. So it really requires, the 2 CFR requires this whole concept of grant-based or fund accounting. So I've heard that GBA, grant-based accounting, mentioned already. That is that guidance is also only a few years old about how grantees and project sponsors need to book information, and all that's in 2 CFR. So it's a very important set of guidance that's important that everyone understand. So bottom lines, to be reimbursable, all expenditures have to be allowable, reasonable, documented properly, allocated appropriately, dispersed in a timely manner, benefiting eligible households, and not generating profits for grantees or subrecipients. And so we'll go into what all that means through this presentation, what allowable, reasonable, allocated properly, et cetera, means. So to get there, when we're talking about good financial management, we want to understand basic cost principles, and we'll be focusing on that in the first half. Developing policies and procedures related to financial management, implement system controls, checks and balances within your management of funds, creating a good documentation trail, as we talked about, and being able to confirm the accuracy and completeness of your activities through the generation of reports, through audits, through ongoing monitoring of your operations. So, cost principles, everybody's favorite topic. We're going to be talking about direct and indirect costs in a little bit, and starting with just some basic cost principles. We'll be looking at what an allowable cost is, reasonable cost, and the allocation. So, starting with allowability. This is hopefully this graphic makes some sense, but to be a reimbursable, costs must be allowable through all the different parts of this. So at the core of it is the 2 CFR 200. Not HOPWA specific, it's just for all federal funds. There's basic cost principles about what's allowable, not allowable, but it doesn't get into the specific activities that HOPWA funds, right? And then you have these layers of statutes, including the statute that authorized the HOPWA program, and then the regulations that articulate that at 2 CFR 574, that's the HOPWA regulations. Anything that is charged has to fit in with the articulated activities in the HOPWA code. Grantee agreement will further narrow that list, so the grantee may not be fully funded, especially if you're a competitive grantee, to do all of the eligible activities. You're only approved to do a subset of those eligible activities. And then with the project sponsor agreement and contract, that'll further narrow that. So there may be a whole long list of eligible activities for HOPWA funds, but by the time you get to a program project sponsor grant agreement, it'll be a narrow, in almost all cases, a fairly narrow set of activities that you're actually approved for. So even if a project sponsor spends money on an eligible activity, if that was not in their grant agreement with the grantee, that would be an ineligible expense and subject to repayment and recapture. So that's the whole kind of network of allowability, what it means. What's a reasonable cost? 2 CFR Part 200 goes into what that is. And it's a fairly reasonable and straightforward definition, I think, that the cost, the expense that you've paid for is commonsensically seen as ordinary and necessary to the operations of your program, that you've paid a reasonable price for that purchased good or service, and that it was purchased and the money was spent based on sound business practices. So I think the reasonable is a cost reasonable after you've determined that it's allowable is fairly straightforward, and is this language is there to really prevent paying an extraordinary price for something that is part of your operations. So with reasonable costs, again, to back up this principle, that a purchase would have been made using standard agency practices and policies, and that they acted in circumstances considered prudent. And so with that, what's implied in that, in making a purchase or spending money, and making a purchase is doing something like should be considered, when you're, even with a TBRA, when you're spending money on a unit, it needs to have been that it needs to kind of meet these reasonable standards. That implicit in that is that you have policies and procedures and guidelines in place about how money is going to be spent. So just as at the program level, and Rusty will be talking about more of this later, at the program level, you're going to have policies and procedures about defining who's eligible, how your program will operate with clients, who will be, how a unit will be inspected and all that stuff. At the financial level, every agency and organization should have financial policies and procedures in place that define these things. With HUD's standards about the source documentation, I think that this is a fairly straightforward slide, so I won't spend too much time on it. The concept here, again, is that there be source documentation that clearly establishes that the money was spent during the approved period. So if you have a 12-month grant, a project sponsor would need to produce documentation that the cost was incurred during the grant period and not outside of that, not before or after that grant period. You would need to be able to document that it's eligible. You would need to be able to document that expenditure was approved by agency staff. And then again, that goes to with something, I'll use the TBRA program as an example again, when payments are approved for a landlord to go on behalf of a client, there needs to kind of be this documentation trail that shows that those payments were reviewed and approved, that the kind of the package of compliance of the inspections and the FMR and rent reasonableness and anything else that's applicable was signed off by somebody with the authority to do so at an agency. And so again, to create the paper trail. An example here is being able to match up these different pieces of documentation internally at your organization to show it, so to back up a purchase. So having a purchase order that clarifies what was ordered and at what the cost of that was, receiving a report that shows when an invoice was received and dated and who received it, and then a vendor invoice that is showing what the vendor billed. So that's like a procurement or purchase of service, but again, if you think about payments to a landlord, there'll be similar types of documentation that need to match up with each other. Your agency would be sending out a check to the landlord, and that the invoice for that will be the lease, right? You have a lease documentation that specifies what the monthly payment to the landlord will be. You have a payment agreement with that landlord. That kind of is like an invoice. It's going to be dated. It's going to be signed. The payments going out is connected to that client file. So being able to look at a bookkeeping system, connect it with the client documentation for those client level activities, all of that needs to be integrated in your documentation system. Well, record retention is just a reminder that everyone's required to retain documents for at least 4 years after the end of the contract, a particular contract, and the submission of the final report. So that would be 4 years after the 90 days after your end of your contract when you've submitted a report related to it. This is just a quick mnemonic to try and keep all of that in view. Is the cost reasonable, allowable, documented, allocable, and reimbursable? Radar. So hopefully that helps. It's kind of corny. It's helped me over the years to keep track of all these different concepts and keep them in view at the same time. So cost allocation. This is where we start to get into trickier territory, and we'll start talking about direct and indirect costs and some of the differences there. With cost allocation, it's very important, again, that at the organizational level, for every cost, that it be allocated, that is directed or tagged or tied to a particular funding stream, and be charged to that particular funding stream in a clear, reasonable way, right? So when I'm talking about a funding stream, and an activity associated with it, that's going to be this idea of cost centers. Is that, who is familiar with that idea of a cost center, right? Okay, good. So if you're at an organization and are having to code any information, like even if you're, say you have a printer, that people have to like put in a project code to be able to print to it, that's because you're associating the cost of how much paper is used with a particular cost center. And that enables your back office to actually say, okay, we're going to charge the HOPWA contract 100 sheets of photocopy because that's what the system, that's the coding in the system. So all of that lets your system do that because that's this grant-based accounting and fund tracking idea with cost allocation. So all costs need to be very clearly and in a well-documented way associated with every with a particular cost center, where HUD and an auditor will get uncomfortable, if I can speak for HUD, correct me if I'm wrong, Rufus, but will get uncomfortable is if in doing some monitoring those tie-ins seem murky, right? If it's hard for a monitor to connect an invoice that was sent to the grantee with a clear set of well-documented charges, that's when questions will start to come up. And so that being able to kind of produce that trail is very important. So shared costs are where we're going to start getting closer to talking about indirect costs. Shared costs are costs that are not as clearly charged to a particular cost center. So for example, when you're paying rent on behalf of a client, that's very clear. That's your HOPWA program. You've got a line item for TBRA. You're paying out of that. It's a very clear cost center. The building that your staff is housed in, right? Say you administer 5 different programs. You have one building. You pay rent on that building. The rent on that building is a shared cost, not clearly attributable to any one program because it's covering multiple programs. So what you're going to have to come up with at the agency level, and there's different ways to do this that are acceptable, but it's important to have one in place, is a reasonable method of dividing up those costs, right? So that's when we start to get into indirect or shared costs. So you want to have this last bullet's very important, and it comes up a lot in our TA, and I work on the Ask a Question help desk. It comes up for HOPWA, it comes up a lot. Having a cost allocation plan in place, and that cost allocation plan is a document, kind of the equivalent on the financial side of a program manual on the program side of saying how your finances are going to operate. So with that example of the building that houses all your programs, you want to have documented in there a reasonable way of saying we are going to base it based on square footage of how many staff take up how much space. So our HOPWA program takes up 30% of our building, so we're going to charge 30% of that rent to the HOPWA grant. And as long as that's a reasonable choice and it's documented, that's the kind of thing that goes into a cost allocation plan. So as I was just talking about, there's different reasonable and acceptable ways of allocating those shared costs. Percentage of total FTEs could be one method. The ratio of clients served relative to total number, if a lot of the burden of your shared costs is on direct client services, how many clients come into your building, could be, or the percentage of square footage used, or the relative contribution of the grants. The HOPWA grant is 30% of your annual budget, so 30% is going to be charged. There's different ways to do it. It just have to make sense, and it has to be consistently done for all programs. So you can't have a program. What HUD and the federal government don't want to see is that their resources are being disproportionately charged with a cost. So say other grants don't want to pay for that kind of overhead, so you charge 100% of that building rent to HOPWA, even though it's only a third of your agency's operations. That would be a red flag. So there just HUD doesn't want to be overcharged. Direct costs. I think that a direct cost is pretty intuitive to most folks. What a direct cost is, it's a cost that you can very easily attribute to a particular grant or activity. So some examples like a case manager, or if you have a staff person who 100% of their time is spent administering a TBRA program, a HOPWA TBRA program, you know that 100% of that person's salary is going to be a direct program activity cost for TBRA, or the money that's going out to a landlord. It's fairly straightforward. I think that concept of direct costs, where it again starts to get murky, is indirect, because very few people are paid 100% on a grant. It does happen, but a lot of people, you might have Ryan White money, you might have HOPWA money, you might have Continuum of Care money, ESG money. You might have a program that has multiple staff persons paid off of a kind of a pool of money that gives you a coherent program, and you'll have to figure out, again, how to allocate those costs. So the concept of indirect costs, again, starts to get to that where it's not so easy. With staff time, I think the concept is that those should always be pretty identifiable as direct costs that you can slice and dice, and that is, we'll get to it later. I think Rusty has the pleasure. We'll be talking about timesheets and that kind of documentation of time so that you can make a good allocation. But it's really when you talk about facilities and administration that it gets harder to make those allocations, and that's when you get into indirect costs. Reminder, that last bullet, not all there's administrative costs and indirect costs are not the same thing. Administrative is very specifically defined. Administrative costs for HOPWA, in the HOPWA regulations about related to oversight, monitoring, reporting, that kind of administration of funds. But indirect costs can be something like your facility that houses your staff. That's not an administrative cost. It can be associated with your grant and charged directly to your grant, but it might, I'm already getting, yeah, into the weeds. But this is where it does get tricky, and whenever anyone asks about this, I say really make sure you're consulting your organization. For a nonprofit, should have be associated with an accountancy firm for your annual auditing that can help you sort out these questions, because they are subtle, but they're very important to get right and make sure. And I think actually a lot of organizations run the risk of under-billing their contracts because they're trying to fit too much into that 3% or 7% admin costs that might be shared, but really can be directly charged to their grant and don't have to be shoehorned into that indirect. I have a couple minutes, so
Two questions I have here.
yeah, so I'll stop on this and maybe we can spend a little time, quality time with direct and indirect.
Yeah, do you want to say anything about that, or you want to do questions?
I'll say that there's if you really want to be confused further, there's a speed session this afternoon that I'll be doing on indirect costs, Rusty did yesterday, where it's purely devoted to this question. So I'd refer you to that. Yeah.
There was one, where can we view a sample HOPWA budget that provides a breakdown of eligible costs?
So the question was, where can we find a sample HOPWA budget that defines eligible costs? I don't know if in the toolkit on the HOPWA section of the HUD Exchange has a sample budget. But in the question of eligible costs, I'll say two things about it. So the first off, in the HOPWA regulations, and you'll see it in the oversight resource guide and any of the related training, I think fairly straightforwardly articulates what eligible HOPWA activities are, right? The tenant-based rental assistance, facility-based assistance, and operations, the short-term rent, mortgage, and utilities assistance, a resource ID, supportive services, admin, housing information services. So those are fairly straightforwardly, but I think the question's more about what kind of costs make up those activities, right? About what can be considered. So that is where it gets trickier. Where I would start with that is, and this is again, a common theme that you'll see in some of those financial management trainings, and this comes up all the time in the HOPWA AAQ. I'll go back to TBRA, right, as an activity, because I think that's very straightforward. I think a lot of organizations, it's very straightforward that those rent payments are charged to the TBRA line item, right? It's very important to know and to keep in mind and to build into your operations that your staff costs associated with determining eligibility, doing inspections, determining the eligibility of a unit in terms of fair market rent reasonableness, communications with the landlord, determining client eligibility for TBRA, all of that is also direct TBRA line item activity cost. So if you see there's different ways, and I've seen every way to construct a operating budget for HOPWA programs. So there is no one way to do it. But I've seen budgets that are oriented to things and people, like there's just one line item for personnel, one line item for, building rent, that sort of thing. But that doesn't really connect those costs to your eligible activities. I think I always encourage project sponsors to construct your budgets aimed at the activities, not at the cost types per se. So because what you'll want to be able to do is with that personnel time, say, you want to be able to identify in your budget and in your operations the staff time spent on different eligible activities. So all HOPWA staff time is not supportive services and case management, right? That's its own thing. So staff time spent on case management should be charged to supportive services. Staff time spent on TBRA or determining STRMU eligibility should be charged directly to the STRMU line item. And because at the I'm sorry if I'm like getting too far in the weeds. At the HUD level, the grant level, when they draw down money from HUD, they do not draw down personnel money. They do not draw down rent expenses. They draw down based on activities. So the system that they go into, the IDIS system, to draw down, it is for your projects, if you're a project sponsor, it is at the activity level. It doesn't ask about personnel costs. It doesn't ask about rent. It doesn't ask about telephone. It asks about TBRA. It asks about STRMU, supportive services, admin, at the activity level. So there needs to be a bridge between what the project sponsor is doing and the budget that they have, that is a budget that talks about telephone and photocopying and paper and rent for the building and all of that, that allocates all of those costs to an activity. Because at the grantee level, they have to book it with HUD at the activity level, right? So that's a very long answer to say, no, there isn't a standard budget. But what your budget, that's what this whole, with cost centers at the agency level, you need to be able to have those cost codes that you can tag all of your personnel time and your paper and your telephones and all of those kind of overhead costs to a particular activity, so that when it comes to sending that information to the grantee, They need it at the activity level, right? Not at the line item level. So however you construct your budget between the grantees and the project sponsors, and again, I've seen grantees prescribe different types of budgets for their contracts. That's ultimately what needs to happen, and at the sponsor level, they need to be able to take that information and allocate it to a particular eligible activity.
I'm afraid to give you another question, Jonathan. So Rufus and I were just talking. So quickly, is there a percentage of staff time that can be allocated towards STRMU, TBRA, PHP costs? Is there a tool of regulation that provides guidance on this?
No.
That was a quick answer. No.
No, but that's to say that I think what that's asking about, is there a cap? And no, there's not a cap. So if, let's say for your TBRA program, I'm just going to use an outrageous number, but let's say, you know, you had $100,000 for your annual budget in your TBRA program. You take, because you're poorly managed, but you take half of that budget just on determining eligibility. There's no cap that says, other than your grantee approving it or not approving it, to say that you can't spend half of your activity budget on that staff cost. So I think that that's what was implicit in that is that there's something like a cap there. You know, there's the 7%, 3% cap on admin, 7% for sponsors, 3% for grantees. There is no such cap on the direct activities. So there's no prescription about how much time can or can't be spent on personnel related to directly administering an activity. Is that getting at the question, whoever asked the question? So I'll turn it over because we got lots more to cover.
All right, thank you, John. Let me just say, Wayne, and to the folks who are standing in the back, because we've got about 45 more minutes, there are plenty of seats up here if you're in the back and standing and would like to be seated. Secondly, I want to acknowledge that many of you are submitting questions through the app. We do have them up here, and as we move toward the end of Rusty's presentation, we'll address some of those because there are some very interesting questions, as Rusty will tell you, that we were looking at. So I do want you to know that they have been received. The app is working, and we're going to get started with Rusty's, but we'll work through those questions we've received so far toward the end of the presentation. Thank you.
Yeah, and just as a reminder, if we don't get a chance to answer all of those, HUD is collecting all the FAQs, as I announced earlier, and they're going to be answering those as a follow-up. So I'm going to pick up where Jonathan left off and kind of continue the conversation with particularly, first of all, talking a little bit about the grant-based accounting system as well as the internal controls. And I think actually some of the questions that are coming up are similar to this. And so I think it may answer some of that as we move forward. So as we think about grant-based accounting, it kind of goes what Jonathan was originally talking about. It's all about the requirement to go back and be able to track our expenses, the things all the way back to the grant itself. And when we talk about the grant, we're actually talking about the award for that particular year and being able to track down to the level of expenses. And as Jonathan was saying, it's not just accounting for the direct activities that are outlined within the HOPWA grant or your contract, but it's all those costs that make up that expense. So if you're doing case management, it's all the costs that Jonathan just talked about. It's not just my service as a case manager, but everything that it takes for me to run that program. And so I'm tracking those expenses in a way, and we're going to talk a little bit about that. So basically, what you're wanting to do is in the coding of the expenses is making sure that we can track it down to, for example, the grant, the contract level, to the cost type, and this idea of supportive services. And then we even go down to that next level. And most accounting software allows you to do this, allows you to have this multi-level coding mechanism. Because under support services, even though, as Jonathan was saying, that when we apply that to the grant under HOPWA, there's all these other costs associated in there. And there may be different categories that we're wanting to pay attention to. So for example, under support services, because transportation would be an eligible expense, I'd want to track those expenses separately than I would staff costs, for example. I'd also want to think about if I was running a nutrition program, that I'm going to track that information separately, because all of that gets rolled up into the financial system. So a lot of this really is about working, in my mind, making sure that program staff understand the kind of eligible activities and the things that you're working on that, and then you're working with your finance department to make sure that those costs are getting coded and then allocated in an appropriate fashion, so that appropriate reports could then be provided to the administration as well as program staff that are over the monitoring of those grants. And so these traceable codes and the coding, I think this is just part of life that we all live in, right? So I know that none of us really like to have to code every single thing that comes in to the agency, every single expense, but honestly, that's the only way it's going to happen, to be able to make sure that, one, you're capturing the costs, and I think critical to this is making sure that you're capturing the eligible costs that you can then put in your invoicing to get reimbursed for. And I think that's the most important thing. So often what happens, I think we have costs that we've incurred within the agency. We haven't coded them properly. They get put into general administration or something like that, and we haven't picked them up. And they actually are eligible costs that can be going into our invoices for reimbursement from HUD or the other federal partners. And the only way you're going to capture that is making sure, one, that you have a mechanism to do that, and two, that you're periodically monitoring that. And we're going to talk about some of that internal control as we go through this. So that paper trail obviously is really important. There's four elements that we're going to be working or thinking about. Here, one is budget controls, accounting controls, internal controls, and then kind of your human resource system. So we're going to just touch on some of the things that you might want to be thinking about as we think about your own policies and procedures. So even though obviously the 2 CFR 200 as well as the HOPWA regulations outline several things related to financial management, you have a lot of tools and resources available. As Jonathan mentioned earlier, a lot of this then needs to be translated into your agencies and actually put into policy. And that's the main thing, so that you have standard policies and you have a process by which you have the checks and balances, that everybody knows kind of what role you're playing in the agency to ensure that the budget controls and the accounting controls are implemented. It's a great thing to have policies and procedures. It does us little good, though, for not following those policies and procedures. So we want to be able to do that, obviously. So as we think about the budget controls, so the budgets obviously is what guides us in the work that we're doing. Most of us know that. As we're thinking about finance, the first thing we think about is the budget that I'm operating in and what I'm going to be using that. And so part of budget management, most of this should be pretty intuitive because most of us have been working with budgets for a long time. It's basically monitoring those expenses against budget. So it's a budget versus actual, and what are the reports that I'm getting out of my system to be able to monitor that, and making sure that I'm keeping on a periodic basis, usually monthly, I'm looking at those financial statements that I'm getting from my finance department to make sure that I'm going on track. Obvious reason for this is, one, I'm reviewing that from a budget standpoint. Is there anything that's odd within those expenses that have been encoded to the project, to make sure I catch anything that may have been miscoded, right? Because mistakes do happen, and we want to make sure we're catching that. And it's also the monitoring to make sure that within my budget line items is everything where it needs to be. Am I over, under, significant, that I need to make some kind of modifications? I was asked yesterday, I guess, when in the indirect, what do I do? What's the leeway we have as grantees to make budget modifications? And remember that nice centric circles or concentric circles that Jonathan showed you. I think those changes in your budgets really starts with whatever the grant agreement is from HUD, and that financial management process starts there. It goes down to the grantee and any limitations the grantee has set on any kind of budget changes that can be made, and then ultimately to the project sponsor. The project sponsor, you may even have your own kind of internal mechanism, what could be charged and so forth to certain things, but those budget modifications then are there. So we're kind of tied in all three of those levels. And so I would encourage encourage you as project sponsors to work with your grantee to kind of understand what is the leeway, what are the ways in the process we would go through if we needed to do budget modifications. But part of those budget controls is really having that mechanism in place that I can track and look at those variances, and then be able to plan appropriately on how to make those revisions as needed. Program income is always a big issue, and so there's the thing here with program income, if you're receiving program income, and so this is anything where through an activity that you're operating through one of the federal sources, in this case we'll take an obvious one where it's tenant-based rental assistance. If you're operating a tenant-based rental assistance, what's happening usually is that there's a client contribution, and if you're collecting that client contribution, that might be one example. There could be other examples where you might get some program income coming into the agency where because of the service you're delivering, there's something coming back to the agency that you need to collect. The idea here is make sure you're tracking that information, making sure that that information gets, that you're recording that revenue coming in, and then use that revenue for the HOPWA eligible activity. So if you are collecting, for example, a client rent payment coming in, make sure that that goes back into your program income and that you're using it for that line item and offsetting your expenses, and have a mechanism in place to offset the rental assistance draws that you're doing with that program income in there. So I think my main thing here would just be noting a lot of times it's small stuff in here, is just paying attention to, is anything that I'm doing, does it result in an income coming in? If so, that becomes a program income to the agency as a result of that activity, and then make sure you track it and then tie it back to the activity, the HOPWA eligible activity that it was kind of used for. I think that becomes the easiest process for the tracking and the cleanest process for the tracking. Yeah. Taking a deposit. I'll repeat the question after I get the whole thing.
So if that would be a program income, so maybe you say deposit back in 12 months.
Mhm.
You're saying these go right back into deposits.
I think with deposits you can keep it. So the question is about the rental deposits. If you collect a rental deposit, the key here I think is making sure that you track that rental deposit, and that you're, in that case, it becomes, I think, a liability to the agency because you're keeping that deposit for a period of time because you may actually return that deposit. And so it's making sure that you're keeping adequate records of that collection. It's on your financial statements, and that becomes something that you're able to show both the receipt as well as any returns that you're giving back. That all has to be tracked in that way. Deposits, I think, are slightly different just in the treatment of it, is my opinion of that, just because of how it works, because you want to be able to keep that and then pay it back out. So I don't know, do you want to say anything about it?
Just to I don't know if this works. Do you mean deposits paid to your organization, like say for a facility-based housing?
Yeah, you need to be tracking that. Yes.
That would be,
Yes.
yeah,
That
that
is
would be
program
income
income, yeah.
coming back.
Yeah, that's program income. It needs, no, go ahead.
It just needs to be for an eligible activity that's in your grant agreement.
Yeah, yeah. So just to clarify what the question was, this was in the PHP where the deposits, you're paying deposits, rental deposits. There is the need to track that you've paid those deposits and then do due diligence at the collecting those deposits back that you've made. So you are helping somebody get into housing. I pay their deposit to get into that housing. You're recording that that was a service paid under permanent housing placement, that I'm also doing due diligence to get that back once the tenant leaves, assuming that everything's fine with the unit. I get that back from that landlord. I record that as program income, and then that program income needs to be used towards another eligible activity. Accounting controls. So part of this is just having controls in place, and I think a lot of this also ties into the having different roles and responsibilities and making sure that that folks know those. So, such as safeguarding assets, authorizing transactions. Jonathan talked a little bit about this through the process of an invoicing. Who has the authority to, one, review those expenses? Who has the authority to authorize an expenditure, who has authority to write those checks, and, obviously making sure that one person doesn't have that whole role and responsibility. And that becomes difficult in smaller organizations, I recognize, but still having those separation of duties, making sure that within those accounting controls that we have a place, whether it be a board member or something else, is serving certain functions, and making sure that one is documented, and then one that periodically that is being monitored within the agency by agency administration to make sure that that is followed. So I think a good rule of thumb or a good practice is to periodically monitor yourself, to periodically go through and have somebody just do the checks on these kind of accounting controls to make sure, are they in place, and are we following our own policies and procedures. Certainly monitoring disbursements, so paying attention to the disbursements that are being made, making sure that appropriate signatures were on there and authorizations were in place, and making sure that we're reviewing both on the programmatic side, the reports and the financials that we're getting, as well as just standard profit and loss statements and other financial statements, that on a periodic basis we have a mechanism in place that you're accurately reviewing those records and correcting anything in them that needs to happen. So I think some of this, where very concretely where some ideas might come in, is when you're doing when finance produces an invoice against monthly expenses, who's reviewing that on the program side. I think sometimes finance doesn't always know some of the expenditures or things, and so making sure somebody's checking the timesheets, making sure somebody on program is reviewing kind of the expenses that are going on there, raising any questions of finance and saying, I'm not sure why this got charged or what this is about. So there's a kind of a check and a balance between your finance and your program staff, just because finance just doesn't always know the nuances of your programs, checking on some of those, and then there's a final review before that goes on to be reimbursed or submitted for reimbursement to your grantee. Again, a lot of this also has to do with the backup that you're providing, which we're going to talk a little bit about on the accounting controls. I talked about that separation of duties, and I think there's, like I said, I think it's a little bit about the on the accounting side. So it's everywhere from who approves an expense to who does the deposits, who's balancing the checkbook and balancing the credit card statements. All of that needs to be kind of separated in such a way that there's internal controls in place, so no one person has responsibility for the whole process. This is as much as for the protection of the individuals as well as it is to make sure that good financial controls are in place. I think also, as you're seeing, this is a lot of information, so I think the more that we can train our staff, and so I would really highly recommend that all of your staff go through the curriculum that Jonathan mentioned earlier. It's all free, it's all available, and maybe doing that as a group and going through that so y'all can, it's always a good refresher, because a lot of us have been doing this for a long period of time, but it amazes me is every time I'm reading something once again or talking about it, it's like, oh yeah, I forgot about that, or oh, that's a good reminder, So all of us, even though you've been doing it, it's nice to read something and just remind yourself, oh, okay, that's why we do what we do. Board oversight is an important function. So remember in your nonprofit organizations that all this information, and it's a requirement that they're reviewing both the audit as well as like the 990 and other things that are happening. And so that board function has to be there. And then monthly or whatever schedule they're on is making sure that the finance committee or the whole board, however you're structured, is also reviewing those finances. I would also say, remember, they also have that control over the budget. So it's also that approving of the budget that kind of sets in motion a lot of these things. So I think a lot of the reason why that is there is because it gives us, as nonprofit execs, to make sure that we're being diligent, because you have that third party, and it makes us go through this process of ensuring that we've done all that we're supposed to do. So it's kind of that check and balance, if you will, for management. And so I think it's an important thing to make sure that all of this information that we're providing is clear, and that our boards are well trained as well on their role and responsibility in these accounting controls.